What's up, traders? Matt here with your weekly watch list coming out late on a Sunday night. We've got to keep it pretty brief today as I've got recovering lungs. Long story short, if you were watching pre-market on Friday, I was kind of having a coughing fit there. It did end up leading to an asthma attack, first one in my adult life. That's kind of besides the point. The only reason I bring it up is to let first-time viewers know that this is not typically how the weekend show goes. But bear with me. We will, of course, get through our broad market. We will take a look through our core list of companies, and I do have 4 additional trade ideas to share with you towards the end of today's video. As always, resources are linked down below in the description. Let's get right down to business here. Excuse me if I do have to sort of edit out a cough here and there, but we're starting out on the monthly time frame because we closed out the month of July. So if I just zoom in here, let's talk about candle structure and location. For structure, obviously we've got a full-bodied green bar indicating that the buyers are in control here. The most important structural takeaway is the fact that we closed up at the highs of the monthly range there. So structure, clear win for the bulls. In terms of location, on a bar-by-bar analysis, we do have a lower high, and we've also got a higher low. That would mean that this is an inside bar, and we typically play inside bars by either waiting for the break of the container bar high or the container bar low. And based on just a clear probabilities outcome, I would say it's much more probable, let's draw this in like this, that we breach the top end as opposed to reversing all the way back down towards the lows and then breaching the container bar low over the course of the month of August, right? Probabilities would certainly favor some more upside lift here, if not remaining inside of range and putting in another inside bar. From a trend perspective here on the monthly time frame, I would also just remind you that we are technically in a monthly downtrend with lower highs continuously being produced. To neutralize the monthly trend, we would need to make an equal high much closer to this, what is that, 460-ish area, and we'll see that on the weekly and daily in just a moment as well. But for all intents and purposes, just bear in mind the monthly chart is still technically in a downtrend. Let's quickly take out the fibs because I do want to provide some perspective and context off the lows from the sickness. Just keep in mind, again, is this doomsday selling? Is this end of the world type selling? Absolutely not. It might feel that way on the intraday, but in reality, we've just come in for a 38.2% retracement, aka healthy bull flag consolidation, from the perspective of the sickness lows up to the all-time high. So really not that bad in the grand scheme of things. Let's drill on down to the weekly time frame now and talk about the same type of stuff. So structure and location, obviously solid bullish bar here, close up at the weekly highs, a little bit of a lower wick indicating that the buyers clearly stepped up off of the lows. excuse me. From a location perspective, I would say the most important part is the confirmation of the break of the multi-week balance. We sort of were thinking that the breakout might have come last week with the close above. Obviously, we've now confirmed it. From a trend perspective, we also have an equal high for all intents and purposes up towards this 415 area, which has neutralized our weekly trend, right? So instead of putting in, high, lower high, possibly lower high here. Obviously, you can see we have more equal highs now. And again, if we can put in a higher low pullback, then we're all good here for confirming a new weekly uptrend. Just to give you an idea of where an ideal pullback would happen, as long as we're pulling back and respecting this sort of area here, we're all good on the weekly time frame. It could start to build out as a little bit of an inverted head and shoulders. That would, of course, lend itself as a neckline. And then we see lift after that for trend reversal. Just a, sort of speculation there on how it could unfold. I'm not saying it has to unfold that way, of course, right? So watch this as critical weekly support here into the upcoming week. To give you a number, roughly 391, right? Let's drill down to the date. Actually, before we do that, I've got one more weekly thing in my notes here. So the volume profile, we typically look at high volume nodes, and I just wanted to remind you that we're now sitting right at the high volume node, which could lend itself as resistance, right? Not only do we have structural resistance here for the equal high, but we also have that high volume node. So we're quote unquote home, if you will, moving from high volume node through thin volume up to high volume again. We can sort of take a breather, if you will, and let the buyers sort of relax here. I think we'll look at a number of things throughout today's video that would point to the rally potentially slowing down here in that high volume node is certainly one of them. Let's pop on our regular study set. So 50 SMA in blue. Oops, there we go. 200 SMA in green, and we've got our drawing set here. All right. So daily time frame chart now. Let's talk about expected move first. I always like to just sort of bring this up. Here is the week's expected move. Notice that if we respect the expected move, then we are either going to set a new higher high or we're going to pull back for a clear daily higher low. There we go, right towards the resistance from the FOMC, sort of where that rally pittered out towards the end of the day last Wednesday, right? That's 402.80 on the downside as critical support here, bottom edge of the weekly expected move. So really the uptrend that is, very, very clearly in place on the daily time frame, lows, higher lows is likely going to continue with either another higher low, and it could even breach that 402.80. It could technically come a little bit lower into that 395.75. We'll look at that on the hourly in just a moment, but it could do that and still produce a daily higher low, preserving the daily uptrend, okay? So are we getting a little bit extended? I mean, have we seen a significant breakout? Absolutely. We're up aggressively 3 days in a row, and I do think some of this is due to a short squeeze / gamma squeeze. I'll show you some evidence for that in just a moment here, but just be mindful of this pullback. Again, weekly high volume node, we breached the expected move from last week. So number one, that's obviously a clear indication of buyers being firmly in control, but the market might start to be getting a little bit ahead of itself is what I'm getting at. Now, I just mentioned gamma squeeze just a moment ago, and the reason I bring that up is because if we take a look at the SPX, which is sort of the mother of all products, if you will, come on over to the trade tab, excuse me, and pop open our option statistics down here from Friday. Look at what's going on, with the sizzle index reading nearly at a 5, right? So this is the volume that traded on the Friday session in relationship to the 5 days prior to that. So volume was through the roof on the call and put side, technically, but it just goes to show that as the options market is sort of doing this, again, if you think about it from a dealer perspective, dealers, market makers, right, have to sell you that option. So if you're buying a call, the dealer, market maker, has to sell you that. That makes them negative delta. To turn positive delta, they go out and they buy the SPY. They go out and they buy the ES futures, right? So to neutralize, they're adding buying pressure to the market, and with volume above, well above average on the Friday session, I would certainly start to believe that there could be some gamma squeeze going on there. Anyways, back on over to the SPY. I want to talk through a couple of other levels, and then we'll break out the Fibonacci's, and then we'll get through the sort of sector rundown, if you will. So to the upside, some resistance and things to note as well. We saw this as a high volume node on the weekly time frame, but it's also just overhead supply, right? If you think about it like this, anyone who's been holding from here through all of this sort of volatility and choppiness, if they want to get out for break even and potentially reposition, then they're going to turn into sellers in this general area. So because we're coming into a sort of area of overhead supply, it's just one more reason why the market may slow down a bit here. Some numbers to be mindful of: 415.35 and 418.50 on the upside. After that, this is a must-watch level at 428.65. 3 equal highs here on the daily time frame. We were discussing it in a lot of detail as the market was making this move, saying that this is a weak level. If we reattempt that, it should break on the first test. Well, I shouldn't say that. Depending on how we get there, it should break fairly easily, as opposed to being a really stubborn area of resistance. That would be a better way to word how you should expect the reaction at that level. Now, granted, it's quite far away. I'm not saying we get there this upcoming week, but it is starting to come into view as a potential target. That weekly higher low that we were talking about just needs to remain above this. That was that 391-ish area that we just pointed out. And you can see on the daily time frame that would look like this, and then ideally doing something like that. To show you this level, the 395.75 on the hourly time frame, let's zoom in here. And you'll remember that as the shoulder mark of this head and shoulders from right here, correct? So it did lead to a bit of a liquidation break that happened there, obviously held it to the T on the FOMC rally, and we haven't tested it since, which is why that would be an ideal place for a higher low if we breach the 402.80 and do not make it all the way to that 389.75, right? Ideally, we don't come back here. We put in the higher low there. That would look, picture perfect, rainbows and butterflies from the daily perspective. The weekly perspective is giving us a little bit more leeway down to that 389.75. All right, back on up to the daily time frame. Here we go. And a couple of Fibonacci perspectives for you. So number one, is if we come in and we take a look from the all-time high. There we go. There it is. We're going to grab that, go down to this low from right here. Notice that we have just recaptured, as of the Friday session, the 38.2. Generally speaking, if this is just going to be a big bear flag on something like the monthly time frame, we would have remained underneath that 38.2, which is also coinciding with that 408.20-ish area, the low end of that overhead supply right here as well. So I like that as a critical level, and the fact that we've recaptured it does strike me as a bullish implication here. If the market was going to be a little bit weaker, it should have rejected there and remained underneath for the bears and sellers in the grand scheme monthly time frame chart to remain in control. The other Fibonacci perspective, if we come in from, you could do this two ways, to be honest with you. If you come in from here up to the high, let's just pretend that we immediately get a pullback and, this marks a local top here. Then notice where your 38.2 is. It's still above the weekly balance high that we were just discussing for that higher low pullback. So that checks out as being bullish in my estimation. And even if you want to take this rally as starting from right here, so we had equal lows technically. So let's start the fib here. Let's go from the low up to the high, and would you look at that, your 38.2 is obviously going to be even higher than that, but ideally, or sort of more importantly rather, what I want to point out is that it's coinciding with that 395.75 level that we just discussed as well. So that has been an in-depth rundown of the S&P 500. We are being mindful that pullbacks at this point in time can be healthy for the marketplace. As we pop open the sector list, what we'll find here is actually some more indications that the market could see a healthy pullback over the course of this upcoming week. So number one, energy breaking out here. It's really making that move above these sets of highs that we've been discussing over the last week or so at 76.85. Not really ideal. This is D for defensive. We do not want to see this sector leading the charge to the upside. So seeing this break out and really pushing the S&Ps higher on Friday would make me start to think that, okay, the market might be moving on its last leg because now the defensive and lighter weight sectors are being the ones that sort of prop it higher instead of the more growth-oriented risk-on sectors. And we'll see that in the ratio grid as well. The XLY is a little bit contrary to what I've just stated. Obviously, big gap up on the Friday session and continuation as well. That's because it cleared this big daily resistance level around 157. I would be mindful of higher low pullbacks that fill the gap underneath and then produce a higher low here on the daily time frame. That, of course, would strike me as also leading to a higher low pullback in the SPY, right? This is a fairly heavyweight sector, so to see this come in, fill the gap, and then reverse off of it, I would imagine that that's a little bit of downward pressure for our S&Ps as a whole. But if we're above 157, it's hard to argue anything other than bullish consolidation, bullish pullback, anything along those lines would, of course, fly. The area that we do want to see it stop if the pullback breaks 157 would be here at 152.38. So continuing along, XLI, again, lightweight sector, 7% of the S&P 500. Why is this one kind of leading the charge here? Not ideally what we want to see. Maybe the market is sort of coming into its last sort of push of this, of this individual leg. I shouldn't say. I'm not trying to get overly bearish here in the sense that, the market's running out of steam. It's going to go back down to the local lows. I'm not saying that at all. I'm just saying that the market could see some healthy pullback. Again, the lightweight sectors, the defensive sectors are taking the baton, which is not ideally what we want to see for continuation. XLK, the tech sector, continues to break out here up and over this set of highs. Bullish, obviously. If it produces a higher low pullback, it wants to stay above 138.50. It's not the end of the world if we put in another test at 134, but it wouldn't be as ideal, obviously. This chart looks great to me. It's, again, starting to look like it might require a little bit of a pullback, but is that the end of the world for the grand trend that's starting to build out? Absolutely not is the answer to that. Apologies for those throat clearings. Anyways, that's probably going to do it actually on the XLK. I suppose we should speed things up just a little bit. We'll keep it a little bit more brief here going forward. XLF, bullish, obviously breaking out of this bull flag here. We filled this gap. Could we see a little bit of a pullback because of that? Absolutely. As long as we're above 33.14, all good for something that could potentially do trend continuation like this. In the grand scheme of things, we cannot afford to trade underneath 32.45. Upside target would be a retest of this, which of course would be bullish. Bottom end of this prior overhead supply. 34.61. So chart does look good, but just be mindful of these healthy pullback areas. XLB, Materials, again, lightweight sector. This should not be leading the charge. Obviously, it did towards the latter half of the week. So it also lends itself to the S&Ps maybe being on the final sort of push, hurrah, if you will, of this breakout of the balance, the weekly balance, really, that we've been discussing the past little bit. Same thing with utilities, just like energy. This should not be leading the charge here. Sure, it had a nice gap, but it should have sort of pulled in if the stronger and heavier weighted sectors were going to lead the market higher. Wasn't the case. So again, this defensive sector rallying strikes me as a little bit of a red flag here that we could start to see the market strength deteriorate, diminish just a little bit. Same thing in real estate. Right, defensive sector, it sort of broke out of this. This is totally pricing in that the market does not care about higher rates. This to me is also an indication that we might see inflation peak come the August CPI readings. We'll talk more about that in the TNX in just a moment. But lightweight sector, it's certainly not going to save the market if the XLK is pulling back, if the XLY is pulling back. Again, defensive sector should not be rallying to lead the charge, which sort of lead me to believe that I've been repeating now, the market might be due for a little bit of pullback. Next up, XLC Communications. What's going on over here? This one is still sort of a head scratcher, still inside of this range here. It hasn't broken out yet, and this is, I don't want to say is it the top 5? Let's just find out here because we can, right? So SPY, where is communications? So there it is. 1, 2, 3, 4, 5. It is top 5. Would you look at that? It's 5th in the lineup in terms of sector weighting. The fact that this has not broken out or even gotten any of the love from this rally, strikes me as slightly concerning. Nice volume increase here as we've been putting in inside bars basically on the Thursday and Friday session. I'd love to see this up and over 57. That would be a good first step. And then your next trade, really big bullish push in the communications sector would, of course, be up and over 58.18 for something that does this. That would, of course, help out the S&P 500 moving higher. XLV. Another bit of a sort of concerning look here is the fact that this is just going sideways. Remember that this is the second heaviest weighted component of the S&P 500. That one we do know off the top of our head. And it really didn't see any continuation on the Friday session. Really just neutral inside bar, obviously small body. Nothing really impressive going on here. I will give credit where credit is due. It's technically remaining on higher lows above that 130.50. But again, seeing this go sideways would just support a sideways S&P 500, not necessarily a big rally there. So this too, indicating, hey, maybe we're kind of at the end of our ropes there in the most recent leg higher in the S&P 500. XLP, defensive sector. We know that this had been waiting patiently for quite some time. To see this breaking out here doesn't strike me as concerning compared to what we've seen in some of the other lightweight sectors like energy and utilities notably. So is this bullish pressure for the S&P 500? Absolutely. Inside bar on Friday doesn't really strike me as concerning. This, of all of the defensive sectors, this one strikes me as playing the nicest and not really being as big of a red flag. Let's continue along, and we don't want the internals just yet. We want the ratio grid. So here it is. If you don't know about this screen, I've got a video for you, top right-hand corner. Basically, the top 4 charts right here represent risk on. You'll notice that the XLK still looks fantastic. That is a risk on look. XLY still pointing higher clearly. That's more of a risk on look. The XLV really starting to go sideways. It did technically produce a lower high here, and now it's made a new lower low. So this is definitely in the neutral camp. I'm going to still call it neutral because the 50 SMA is clearly sloping to the upside. And in the grand scheme of things, you can still see we're moving from lower left to upper right. So it's neutral, but certainly starting to flirt with not really an ideal look. And that sort of aligns with everything that we've been discussing that, hey, maybe we should expect a little bit of a pullback here over the course of the upcoming week. Same thing with financials. This is clearly much more of a bearish looking chart here in a descending channel. So obviously just not we're not at full risk on like we were at the beginning and midpoint of last week, right? And then at the bottom 4, our risk off sectors, it's not as bad as 2 for 2, but you'll notice that we've got a sideways XLP. That's kind of fine, no big deal there. Notice the energy is perking up a little bit back towards that 50 SMA. Real estate obviously looks bullish here, which is not good. That's more of a risk off indication. And the utility sector is flirting with kind of a pressure cooker top here on the ratio perspective for a breakout, which would turn it to risk off being on, right? And by that, I mean, of course, risk off is the favored look if the utilities ratio looks bullish here. So not good. And again, this just sort of ties in perfectly with the idea that, hey, the lighter weight sectors, the defensive sectors are leading the charge here. They're starting to get a little bit of strength back in the bottom four. Maybe we should expect that pullback, right? So that's sort of more stacking evidence for that perspective. All right, let's get on over to the TNX. This is the 10-year rate, and we'll just briefly discuss what's going on in here. So again, as I alluded to earlier with the real estate sector, I don't really think that the market cares anymore about 100 basis point rate hikes or 125 basis point rate hikes. Those are kind of off the table, I would imagine, going forward here. Remember that the Fed does not have a meeting in August, so the next rate hike that we could potentially get is going to be in September. And this, again, is just sort of indicating that inflation might have peaked, guys. If we get a read of CPI that ticks lower in August, because we will still get CPI in August, if that ticks lower, then 100 basis points is off the table, 125 is obviously off the table. 75 might even get taken back off the table, and we could go back down to a 50 basis point rate hike times 2, and then get a 25 basis point rate hike to get us to that Fed funds target rate that they've been eyeballing, right? It would really require about 125 basis points from where we're at currently. And again, if inflation ticks lower in the month of August, then this, I would imagine at least, is probably the sort of path forward for the Fed, and the market would definitely like that, right? We've already withstood 275 rate hikes, so 2 more 50s, probably not the end of the world. And again, this chart is just sort of confirming that look, so that's why we've spent some time here. And with that sort of risk taken out of the marketplace, I think we're kind of, I don't want to say in the clear. It's never good to talk in absolutes about the market, but this chart would certainly give me higher conviction that that is the case as opposed to not. Let's take a look at the VIX now, which is the volatility index, of course. This thing falling out of the sky finally. Here was the box of wickedness. We break down, retest, and lower. We are at the support trend line. Could we see a little bit of a bounce here? Yes, but it's not the end of the world as long as we remain outside of this box of wickedness from in the past. Remember that we were talking about in prior videos that the way that the market's likely going to bottom this time around is not with a massive sort of capitulation type bottom read around 40, but rather a dribble back down underneath 2050. And you can see that theory and sort of hypothesis is on the table as still being valid here. We'll also take a quick look at the VVIX, which goes to support the theory that we had earlier about the gamma squeeze. This is still sitting at fairly historical levels, well underneath that 103, which of course would just indicate that no one's buying SPY puts, no one's buying VIX calls, which again would sort of indicate to me that when we were looking at that sizzle index, although the put sizzle was still fairly high in the SPX, we can just go back there and I'll remind you, although this here, the call and put sizzle index, both of them were really high, it might just mean that, obviously people are selling the puts and buying the calls, right? Which would support the idea for the gamma squeeze. And we're just tying it all together with that VVIX chart, which is the, the evidence that no one's buying the puts. They could just be being sold in the SPX. Let's take a quick look now at our internals and see what's going on from that perspective. So here we go. And this, again, is supporting evidence, in my estimation, that the market rally may be coming towards, a little bit of a pause. If we look at the volume reads, obviously our FOMC number, well above 300 million, even scratching at it on Thursday. But you can see that the trend is clearly lower in terms of net inflows into the market. So things are slowing down from a volume perspective. The same thing holds true from an advanced decline line perspective. Very bullish on the Wednesday session, bullish recovery on the Thursday session, and even a bullish trend on Friday. But look at what's going on from this trend line perspective, clearly lower highs, right? So things are starting to slow down just a little bit. Ticks really just focus on the cumulative down here at the very bottom. You'll notice that we have a nice solid build, really strong build on Thursday, and then on Friday again, it's a little bit more muted. So are we coming into a period of less pushing it to the upside? It certainly would seem that way based on the internals. And by the way, if you don't know what this screen is, I've got a video for you in the top right-hand corner. And if you've made it this far through the video, then congratulations to you. You are a true diehard fan of the channel. I certainly appreciate you throughout all of these sort of coughs and, so on and so forth. Nonetheless, second to last thing I've got for you for the S&P 500 is just our market profile. The main takeaways from the market profile are that we have multiple virgin points of control stacking up. This could be number 1. After that, we have number 2 from Thursday, number 3 from Wednesday, and number 4 from Tuesday of last week. So the more of those you get stacked up, the more likely it is that the market needs to come in a little bit and sort of tag up, if you will, for a baseball reference for any of you baseball fans, right? This is like tagging up to first base, and then boom, you can go from there back to the upside once you've sort of corrected a little bit of that. And usually it leads to higher low pullbacks anyways, so it's not really the end of the world. Noting also that from Thursday to Friday, we clearly have a shift in the value area to the upside, and the point of control also migrated higher with price instead of being left low in the profile on the Friday session. So to me, there's a number of bullish, but also start to be cautious indications about this market profile interpretation. Let's get back on over to the platform for the last S&P sort of implication I have for you, and that's going to be on our SPX A200R chart. And this represents this pane up here on the top represents the number of stocks in the S&P 500 that are trading above their 200 SMA. And we really only look at this on monthly closes. What I want to point out is the look that we have here. So notice in June, we confirmed the print in this yellow box. In July, we have now confirmed the print outside. Every single time we have dipped a toe in and confirmed a close above, barring this exception right here, we have made the move all the way. Back to the 50% mark, which would of course imply that we still have some more bullish lift here for the market to experience. You'll notice that would be moving from here to here over the course of August and potentially September, depending on how many monthly reads this actually takes to complete. Could be 1, could be 2, based on some of the prior indications that we have here on this particular chart. And of course, every time we've dipped into this yellow box, you'll notice that that aligns basically with a major market bottom from in the past. So could this be all the selling we get? Absolutely, this chart would support the idea that this could essentially represent an environment where we have seen all of the selling that the market can withstand without seeing a little bit more of a significant lift at this point in time. And again, this is monthly sort of expectations. This is not day trading expectations. This is monthly expectations. So with that, guys, we're gonna get on over to the QQQ. We're going to round out the broad market, and honestly, there have been so many cuts of coughs here that I think I'm going to wrap it up at that. Not sure where I cut out last, guys, but this is going to have to do it here on the Qs and IWM. The coughs are getting a little unbearable, but on the monthly time frame, we are still technically in a downtrend. I want to point that out, number 1. Number 2, slight difference from what we saw on the S&P 500 with a monthly close above the bar from June, so that's slightly more bullish as well. We'll see if we can neutralize that trend. It would, of course, take a move up here closer to 365, 370 in the QQQ. If we just quickly take out the fibs to stay congruent from the lows up to the highs, obviously a much deeper pullback here to the 50%, which we had talked about in prior monthly chart analyses. Anyways, weekly time frame chart here, the big difference is that we set a higher high here instead of an equal high that we saw on the S&P 500. It strikes me as a little bit more bullish than the S&P 500 and even allows for more of a pullback here as opposed to the SPY. Because we've extended through it, you might also adjust your expectations to be, we've breached resistance without seeing a pullback. Now we should sort of expect some pullback activity to take place. Anyways, daily time frame, going to speed it up and try to truly keep it brief now because the coughs are, no joke. So expected move produces a new higher low if we respect the bottom end. So that's a bullish piece of information. We are above this breakout level on the Thursday and Friday session. Some numbers to be aware of and actually some psychology as well. Wow. I'm so sorry, guys. We're already above this big area of overhead supply. Strikes me as a bullish implication. So pullbacks at this point of time want to see congestion around this 307.40 to 311 area. 314 is asking a lot for a pullback at this point in time. It would be like the most mild, the most optimal looking thing if we were to put in a bar like that. That is a big stretch of the imagination to expect the market to respect something like that. I don't think it's going to be the case, but If we do see upward lift, 320 is your target, and then the top end of the weekly expected move is right at 323.90. Moving along, IWM, Russell 2000, the small caps, monthly time frame first. Just to point out another couple of differences here. This is an inside bar. We are technically still in a downtrend here in the Russell. If we're going to make that neutralization move, it's going to be around 210 here in IWM. So watch that on your upside on the monthly perspective at least. Weekly time frame, equal high, more similar to the S&P 500, obviously well above this balanced breakout level. Strikes me as a good look for the weekly time frame. Again, we can afford some sort of inverted head and shoulders pattern. Neckline break would then neutralize the monthly trend. Daily time frame. And then, guys, I apologize. I've got to wrap it up after this. I'll just let you know that the trade ideas are on. I'll look through those quickly and just let you know what those ideas are. But we're not going to spend time going through the broad core list of companies. Excuse me. Break of the resistance trend line. That is the all-time high resistance trend line in the IWM. Strikes me as a bullish implication. Higher low pullback wants to hold 184.25. Worst case scenario for the weekly time frame and monthly to also produce a higher low. 177.60 is your ultimate line in the sand. But again, expected move has us remaining quite firmly above that level at this point in time. Upside lift gets us to the top of this resistance right here around 190.71. And now I'm just going to show you these ideas, not really spend too much time talking about them. BSX, obviously, breakout level, inside bar, looking for higher, 42.75 target. Resistance trendline break could be the possibility here. Big downtrend prior to this, finally stabilizing, going sideways, noted by all of these equal lows. If we break the trend line, look for the top of this area here on 45.83. KR, Kroger, what's going on here? Outside bar on the Friday session, engulfing a inverted hammer. So as we breached those lows, notice we did get a little bit of sell side activity, but the close was so strong and gobbled up that inverted hammer. So sellers trapped. If we get continuation, the high volume node overhead is 48 as a target in KR. And that lastly, we have Chewy, which is just a great setup because it's multiple days of balance, sideways activity, all of them with longer, lower wicks. If we see lift in the marketplace, look for a breakout here above 39.50. Target is to close the gap 49.95, 41. Whew. And then we're off to the races up towards 45.12. That's truly going to do it, guys. We'll see what we can do for a pre-market stream tomorrow morning if the voice is feeling any better, but that's going to do it. So again, if you made it all the way to the end of the video, I really, really sincerely appreciate you. It means a lot that you, number one, would watch so late at night, but number two, also sit through all of the coughing and hacking. So that's going to do it. Appreciate you being here. Thanks so much. See you soon.